Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days, weeks and months ahead. As ever, if you find this show useful or interesting and you're watching on YouTube, please hit that like button, but also subscribe to our channel. And if you're listening to it as a podcast, then please do leave a review on your podcast app of choice. Now, in my last update titled Uncertain Times, I explained how in the early part of October, global markets reacted to the unfolding events in the Middle East and the initial war trade we saw, where investors shifted towards safer assets, moving out of stocks, with the biggest beneficiaries being bonds, gold and cash, and principally the US dollar. Now, gold rose above $2,000 per ounce, with Friday afternoon rallies becoming quite commonplace as investors grew concerned as to what might unfold over the weekend with regard to the Middle East. But as I mentioned last time, equity markets typically react negatively to the onset of war, but swiftly rebound, and this time was no different. But as inflationary concerns and oil price hikes once again began to dominate investment headlines, we saw a surge in bond yields and a retreat in stock markets. Now, the VIX, often termed the market fear gauge, ascended to levels reminiscent of the March mini banking crisis, which encapsulated the market's nervousness. Now, with earnings season well underway, the focus turned to the large US tech companies, which have been driving the wider stock market higher throughout 2023, and they were again among the strongest performers during October. Now, the divergence between the S&P 500 and its equal weighted counterpart so far this year highlights the outsized influence of these tech behemoths. The divergence is enormous. However, as these giants wavered into the month end, partly as a result of disappointing earnings reports, so did the market's confidence, with tech stocks becoming a drag on performance of the wider market rather than the driver as they had been. Now, as October came to a close, the market slump saw the S&P 500's 10-month moving average indicator flash a warning signal. Now, I won't go into details about what that signal is or that indicator, but essentially it's a line of which, if the S&P 500 closes below at the end of a month, has proven fairly reliable in the past to be a sign that you might want to get out of the market, and equally when it's above that line, then it's a good sign that there's some strength in the market, and particularly if there's a rally, that it might be sustainable. But of course, these signals aren't guaranteed, and the last time we saw one of these was back in December last year, and it was a full signal, but nonetheless, it was a sign of how negative sentiment had become in equity markets. And at the end of October, stock markets were widely down around about 2% to minus 3.76%. But as we moved into November, the mood changed and we saw equity markets, particularly in the US, explode higher. So what was the catalyst? Well, for months now, I've been highlighting how rising bond yields and the stronger US dollar have been a headwind for US equities and ultimately stock markets globally. And it's no coincidence, therefore, that as bond yields imploded and fell and the US dollar weakened aggressively, a rocket was lit under the S&P 500, which has now broken above the 4,500 level, which equates to an almost 10% rally from the end of October low that we recently saw, and that low was around 4,100. And it means the index has also recaptured that uptrend support line which it lost this October, and that uptrend line began back in October 2022. So why did Treasury yields tumble? Well, the stage for a potential turnaround in the bond market was actually set at the end of October, when hedge fund manager Bill Ackman announced publicly on X, which is obviously formerly known as Twitter, that he had closed his high-profile bet against the US Treasury market, a bet which he'd also originally announced on X back in August. And Ackman made over $200 million on his latest bet as bond yields rose through September and October. And in his tweet, he claimed that the economy is slowing faster than recent data suggests, and that there is just too much risk in the world to remain short bonds at the current long-term rates. Now, the other way of putting that is he believed bond yields had reached their peak and would begin to fall, meaning bond prices would rally. Now, such is his influence on investment markets that US Treasury yields fell slightly on the news. Now, but if you fast forward to a week later, and the US Treasury announced that it would slow the pace of longer dated debt issuance, which sent yields even lower. Or in other words, the supply of new US Treasuries will now be lower than previously expected, which drove prices up and therefore yields down. Additionally, new employment data in the US suggested that wage growth was slowing, leading investors to reassess their inflation expectations. Now, the market began to price in the possibility that interest rates might have reached their peak in the US, and this sentiment was reflected in a further rallying of treasuries as yields tumbled in response to the changing economic outlook. Then the cherry on the cake was the lower than expected inflation data that came out this week. But that wasn't just in the US, we also saw a similar pattern in the UK. Now, this just meant that we saw an acceleration of the moves we'd already seen in the first half of November. That means bond yields went lower, so prices rallied, and the US dollar index fell. So this is why the 10-year US Treasury yield hit 4.4%. It's fallen down from 5%, while the US dollar index broke below 104. So this caused the euphoria in US stock markets and bond markets, and it bled over to other global equity markets. So US tech stocks are naturally the biggest winners of lower rate expectations, with the Nasdaq 100 up almost 10% since the start of November. However, other markets have fared well too. So the FTSE 100 is the laggard, hampered by its lack of tech exposure and the stronger pound versus the US dollar, but even it is up 2.26% so far this month. European stocks, as measured by the FTSE Euro First 300, are up around 4.3%. Japanese equities up about 8.62% as measured by the Nikkei 225. So overall, if you look at the MSCI AC World Index, it's up about 6.17% so far in November. Clearly, investors are in bullish mood, with the market narrative becoming that central banks have put that inflation genie back in the lamp and now looking ahead to interest rate cuts in 2024. However, bear in mind that the narratives can change quickly, as they did from the end of October, so investors should be aware. These narratives are very fickle and often fleeting, but as hinted in my last video, seasonality could provide a tailwind for stock markets. The 1st of November often marks the start of the strong 6-month period for stock markets, which is the driving force behind the winter portfolio that I produce for 80/20 investor members each year. And it's also the time when smaller company stocks tend to outperform their larger counterparts. Now, there is also, of course, the Santa Rally phenomenon too, which we will have to talk about next time. The reality is that, positive seasonality or not, investors still have one eye on what's going on in the Middle East, with the other firmly still focused on economic data, bond yields, that US dollar, as well as the outlook for central bank policies around the globe. But they are in bullish mood heading into the year end. So if you found that useful, then please do hit that like button on our YouTube channel, and also subscribe to the channel. And if you're listening to it as a podcast, do leave a review on your podcast app of choice.